with the passing of the Genius Act, it's kind of like the arrow of time is going in one direction, right? And so the direction of capital markets is it's going to be settling more and more in stablecoins. It's almost inconceivable that it's going to hit some level and stop where people continue to decide to use fiat.
Quick shout out to today's sponsor, Katana. We'll hear more about Katana's 1 billion cat campaign later today, but for now, let's get into the episode. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. All right, everyone, welcome back to another Bell Curve Roundup. You got Michael's 1 and 2, Vance. We have another special guest this week. We're talking to Sid Powell from Maple. Sid, welcome.
Thanks for having me, guys. Glad to be here.
Yeah. It's the doldrums of the summer when we're just going back-to-back guest episodes.
It's been a pretty busy summer, though. There hasn't been as much just like malaise. The market hasn't really taken time off. ETH's alive, so it's a good summer so far, but we're still only probably halfway through.
I feel like ETH's really leading the pack. Sid, I'm curious. I mean, would love to, get your view on it.
Wait. Before we ask Sid, there's an amazing photo of of the SBET IPO, and there's all this confetti, and then just like you zoom into the back and you see Yano in the back. Just
really?
I'll try to find the. I sent it to Michael last night. It's an incredible picture.
Oh my God! Yeah, please send it.
But sorry,
that's so funny.
Not to interject.
No. How did he look? Was he
happy?
Happy. He looked like he owns more ETH than he used to. So. Wait, I got it.
Yeah, pull this up.
Yeah, we'll pull it up.
Nope, we can't. We don't have the technology. Image file. Bro. We may have to loop in our executive producer to get this photo up.
Maybe, we can dim it in the Bell Curve chat. All right, while we're working on the tech here, Sid, I would actually love to get your perspective. I think we want to use you kind of as a as a representative of kind of like DeFi 1.0, right, and how well that's doing at the moment. But maybe as a jumping off point, we could talk about this bit of news that just came out today, or this report from the SEC, which is the launch of Project Crypto, which is probably the most bullish thing that I've seen come out of a U.S. regulatory agency in at least 8 years that I've been in crypto. So can you just give us the headline of just the crazy 180 degrees that this regulatory body has done, and what was the substance of the report?
Yeah, so there was a speech from Chair Atkins, so chair of the SEC, and I think, as a DeFi builder here in the US, it's tremendously bullish. I think it begins with an acknowledgement that the SEC has probably been a little bit too heavy-handed in the past, but ultimately there's this North Star goal coming from the administration that they want to reshore crypto founders. They want to make the US, the leader for DeFi and crypto in general. And so some of the things that I took away from the report that, were just awesome to see was, one, this desire to reshore crypto builders to the US, acknowledging that you don't need to have kind of this, what they call decentralization theater in the speech, and that you don't need to have teams go and set up these offshore foundations, and that they can, they can be centrally managed in the US, and then a number of pretty important carve-outs for DeFi. So you don't need to enforce intermediaries into DeFi where it's not required and where the technology just solves a problem outright, like think automated market makers and DEXs, and that you can make these products available to Americans, which I thought was one of the biggest, positive takeaways from the speech, who have been left out of airdrops and other, they're often geo-blocks from a lot of DeFi apps, provided that you have, just basic reporting disclosures and features like whitelists. So, as I said, so as somebody building in the US, I was super bullish on this speech. I think it hit a number of the kind of the pain points that people have expressed about the direction that legislation might go in. And actually, one further takeaway was very positive on self custody as a kind of core American right. So I know there were a lot of concerns that we were all going to have to use custodians for everything we do, and that was going to kind of hamper DeFi innovation. So really good across the board.
What a 180.
Yeah, it was massive.
Yeah, I haven't read the full take, but with that also was this kind of like Project Crypto idea where they're doing a kind of aggressive project to bring a lot of the pieces of capital markets on chain today, and they're even calling out ERC20s as the tokens that are going to do this, and it's yeah, I know I need to read it more fully, but even Nick Carter is saying this is pretty breathtaking stuff. So very positive for the industry, and it's down 2% as is to be expected.
Well, I was going to say Nick would be happy because it also explicitly mentions Operation Choke Point 2.0 in the speech, which was a term he coined.
I think he incepted that entire thing into the current administration. It's an unbelievable achievement. Yeah, and really good investigative journalism actually that he and his partner Matt do.
Yeah, I know a lot of research went into that.
Yeah, lots of calls, lots of interviews. So absolutely wild. Yeah, I would be. Do you guys? I was speaking to a liquid fund manager last night who kind of gave me the perspective. Now, his sort of high level thesis is, he's only really interested in things again on more of a short term trading kind of orientation that he thinks the boomers are going to want to buy, and kind of gave the mental framework that the boomers are kind of where everyone was like 3 or 4 years ago, right? So kind of what's heating up in their imagination is like kind of I think that 2021 was kind of the cycle of ETH, and that's when everyone got really excited about this idea of world computer, decentralized economy, the decentralized finance, and yada yada. I think maybe just from an asset price perspective, DeFi 1.0 has been a little challenged the last couple of years. ETH price action has been, but it feels like there's a huge renaissance and push in that direction. And even like DeFi activity on ETH main chain has still been kind of the stalwart and is still the go-to place if you want to deploy, especially anything that looks like borrow-led and stable coins, et cetera. Sid, I would love to get your perspective on kind of the institutional demand around this space. Like, what's it felt like? You've been building for a long time. Like, kind of take us through the journey here of what it felt like in the beginning, kind of the messy middle, and are we coming out the other side?
Yeah, it's a good question. I think if we, we've been kind of building in live since 2020, and if I think back to what the institutional conversations were like back then, a lot of traditional finance companies and Wall Street companies had set up crypto teams by then. 2021, we were meeting folks at Citi and Citi and initially BlackRock. Obviously, BlackRock's made a lot more progress than other companies since then. But we're meeting those teams. They're very interested in tokenizing assets on the blockchain, and but none of them had really kind of made substantial investments or launched anything. And then obviously we went through 2022 and the plug really got pulled on most of those teams and projects. A lot of them got repurposed within the organizations to work on different stuff, and really the interest was kind of gone for a couple of years. And we wouldn't have been able to get any calls with any of these banks in 2023 and early 2024. And now it's come, we've kind of come full circle, and we're once again having conversations with some of the large bulge bracket banks in Wall Street, and you're seeing headlines about JP Morgan considering lending against Bitcoin. And so I think we're back to where we were in 2020 and 2021, but this time with much more traction. BlackRock has tokenized money market funds, and as do a number of other players, whether it be Franklin Templeton, Wisdom Tree, and so I think we've made a lot more progress since then. But what I would say as well is that you're seeing firms who also didn't actually participate in any way back in 2020 and 2021 now involved in the space. Cantor is doing lending against Bitcoin. Other firms are kind of looking to do the same thing. So I think we've actually come further than we did back then, and it's happening at a faster pace now that they're not doing it in this environment of kind of regulatory ambiguity. There's more of a clear mandate. We've got Project Crypto. There is the North Star that the president wants the US to be the leader in the space, and so I think people are taking that as a green light.
This episode is sponsored by Katana. Katana is a DeFi-first chain built for deep liquidity and real yield by redirecting chain revenue back to active DeFi users. The 1 billion KAT campaign is live. Bridge and deposit directly into vaults in one simple click and start earning immediately on your Ether, Bitcoin, USDC, and more. Follow the link in today's show notes to get started. We're entering crypto's cloud era, and EigenLayer just launched EigenCloud to power it. Just like AWS transformed the internet, EigenCloud is a full developer platform that gives developers cloud-grade programmability with crypto-grade verifiability on any chain. To learn more about how the Eigen token is securing a new class of verifiable apps and how to get exposure to this growing class of crypto infrastructure, follow them on X at EigenLayer. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
The other thing I would say is much different from 2021 is the lending space broadly, and there's no Genesis today. And I think in the last quarter of 2021, they did 21 billion of originations and had just an absolutely massive, multiples of that total loan book. And they're gone, but it does still feel like people are very concerned about the amount of leverage that's in the ecosystem. And just to remind everyone, what was happening back then was people were borrowing from retail aggregators like Celsius and BlockFi, lending it out to people like Three Arrows, and nobody had real knowledge of this leverage other than Three Arrows and maybe these few desks. But today, I think even these digital asset treasury companies are kind of orders of magnitude less harmful in terms of, it's a no leverage, generally equity constrained investor base, and they're not really putting a ton of risk on the table other than what's being invested into the companies. But maybe you could talk about just like the Genesis story and how that has shaped the lending landscape today.
Yeah, for sure. And it's worth noting just, in terms of total numbers, like I would have said loans outstanding back in 2021 and 2022 probably got to about 55 billion in terms of assets in those lenders. Today, I'd say it's less than, it's probably in the order of 20 to 25 billion. So we're still less than half what the leverage was back then in the system. But if you look at Genesis, they were the largest institutional lender. Their loan book at its height probably would have been about 18 billion in size. And as you mentioned, they could do multiples of this in originations during a quarter. And they really set the standard for lending in the space. And then you had other players like Celsius and Genesis that had more of a retail focus. But I think what happened there with Genesis was they had a substantial amount of loans outstanding to 3AC against the GBTC and a couple of other assets, and so there were credit losses involved in that lending relationship. And what happened was that you had kind of interlending, or almost interbank lending between the Genesises of the world, Celsius and BlockFi, as well as the customers who were borrowing large amounts from them, like a Alameda or 3AC, Alameda or FTX. And so I think one of the issues was there was less transparency back then, and the underwriting was definitely more aggressive. So you had tons of money being pushed into the system from like aggressive central bank activity and really low interest rates, and that meant that a lot of these companies were just trying to aggressively grow their loan books because that was how they were valued. You were valued as a multiple of your loan book rather than how much revenue you were making. And so often they were lending at well below market rates or even unprofitable levels. As in, imagine the bank paying out 6% on checking accounts and then turning around and lending it out at 4%. Like that was kind of what was happening. And so it kind of hugely distorted the space. Whereas if we fast forward to today, most of the lending I see has tri-party accounts in place, which for those who don't know means that, if I was lending to Vance would put his Bitcoin in an Anchorage account or a Coinbase custody account or a BitGo account. And so he knows where it sits at all times. And if I default, he can still get his Bitcoin back. So it's just a much safer lending practice than what we saw back in those days.
and transparent.
Yeah, way more transparent. Yeah.
So the kind of direct lending space is halved, and then you have probably, I don't know what open interest was at its peak in 2021, maybe 30, 40 billion. Now it's 60. Is kind of the leverage transformed from direct lending into kind of the basis trade? Because a lot of
Yes.
the lending that I assume was happening back in the day was to put on this basis trade.
Was Yeah, yeah, that's exactly right. Like a lot of the firms who were taking on the uncollateralized loans were really just putting on the basis trade with it, and now you've seen those products have kind of, in a way, also been made safer, right? Like they've been tokenized in forms like Athena, and so that's now been productized, and you can just go and purchase it directly instead of putting your money into a fund as an LP and then them putting the basis trade on for you. So I think, yeah, it's kind of the trend is institutionalization, standardization, and productization of all of these things that were kind of more just done in a kind of ad hoc fashion previously.
And I guess another question is, back in the day was, I would assume, just directional punting of the
Yeah.
of the USD that's loaned into kind of whatever, and now it's more delta neutral as a general flavor.
Yeah.
I guess.
As
Sorry, go for it.
Yeah, I was going to say in a not super transparent way, right? Like you saw, obviously 3AC took on substantial loans, and it turned out that was more for directional trading rather than market neutral, which is what they would have represented.
And in terms of the traditional shops that are now in crypto that weren't before, are they still being financed by the usual prime brokers, or have they started to tap crypto capital markets for anything beyond that?
It's actually a mix now. So I think you're seeing, in terms of crypto lending, the other the other kind of emergent company we've seen has been Wildcat, which does more uncollateralized lending. But you can see that the volumes there are kind of constrained. So you have Wintermute is able to borrow in size, like to the tune of 100, but the other players are substantially smaller. Like it's kind of a power law. They're like 1/10 the size. Um, but there's not a lot of financing of an uncollateralized variety happening at all in the space, particularly not to the larger market makers that we see. What they often do is they borrow Bitcoin unsecured, which carries a pretty low interest rate. Think like 2%, 3%, and then they pledge that to players like us and some of the primes or the exchanges themselves to borrow for trading purposes on those venues, whether it be through a prime or they borrow Bitcoin unsecured, post it to us, and then we lend to them in a collateralized fashion. So that's how they're financing themselves. But we're seeing much bigger demand these days. Like we had one, larger sort of more tradfi market maker who took out a 100 mil loan the other week, and so that they are coming back in size, I'd say.
Well, one kind of just orthogonal question is, it's generally very hard to short things in crypto, and
Yeah.
also kind of a bad idea because you can just absolutely get torched on these
Yeah.
things going vertical. But have you seen any kind of pickup in these like directional shorts where people are trying to borrow things to maybe do kind of like long short pairings, or I guess maybe more broadly, like just the short side, and any interesting uses of capital that are just new?
Yeah, we often get requests for what we assume to be short borrows. Like if you're trying to borrow an altcoin, it's generally going to be for kind of shorting purposes. So we see the demand for it, but I think the main issue is it's super hard to get access to it. Like the supply and the inventory is really limited, particularly now that you don't have players like BlockFi and Celsius. Before, Celsius would have been one of the biggest lenders in the market for offering short availability on some of these altcoins because they had the front end retail savings app product that people could put Sol or XRP or other altcoins in, and then they could be lent to the market makers. What we find now, though, is your best bet to source some of this stuff is either to go on the on-chain lending markets, like the full DeFi protocols, or you're going to look at borrowing it from one of the exchanges that allows people to opt into these earn programs. But there's very few desks we see that kind of have the ability to offer short financing these days.
Why is that, Sid? What's like what Is it like I've heard there are games we've talked about a little bit on this podcast before around like if you look at the actual circulating supply that's not super real all the time or 100%
Mhm.
accurate, is it like a float type issue or what's behind the
I think, well, historically, you had a different market structure. So you had these retail aggregators, like you had Celsius, Voyager, BlockFi, who were taking in deposits from retail holders. So, the retail holders had small amounts, but collectively they had a large amount, and so it could be aggregated at the level of a Celsius and then lent to market makers. Whereas now, if you look who are the large holders, it's going to be a fund that is 100% not going to lend you something that they're holding long term, so you can go and short it, or it's going to be the foundation who, for the same reason, is not going to lend you the assets to go and short, or what they assume is going to be you shorting it. So the supply is just super fragmented. There's nowhere you can go to get those aggregated retail supplies, except what we're starting to see is that some of these exchanges are trying to offer these kind of, you can borrow the tokens inside the exchange, walled garden as like a kind of form of prime brokerage of their own.
So do you ever see the people taking another whack at the centralized lending structure that you saw of like BlockFi and Celsius? I'm just curious. There's a habit of going back and trying old ideas. I've seen some algo stablecoins getting pitched again, and I'm just curious. Yeah, if you think that we're going to see a BlockFi or Celsius 2.0 rehashing at some point.
Yeah, I mean, we've been keeping an eye out for it, because they're either, depending on how you look at it, they're either going to be a competitor or a potential partner or customer of ours. And in the we can lend wholesale to one of these players who does retail lending, but a, very very few. Like I imagine it'd just be super hard to get an idea like that funded, right? I mean, it's pretty capital intensive, and there's not a lot of venture funds. Michael and Vance can probably attest and give the venture perspective, but I don't think there's too many people who are going to be tickled by the idea of funding something like that. And what we have seen though is there have been a couple who survived, who were much much smaller at the time, and they've now grown into bigger lenders. But fortunately, they all seem to have taken the lessons of the past and have changed their how they manage risk. So these days you have Ledin, Salt, and Arch, who kind of operate in the North American market doing retail lending. But in each case, they take the customer's collateral, and it's usually held in an escrow account or a tri-party account, like I mentioned before. So they're taking much better care of the customer's collateral, and they put a lot of transparency behind it. So I think, and also in most cases they're pretty conservative. Like if you look at the eligible assets, it's like you can borrow against BTC. In some cases, like Ledin, I think the appetite is only BTC, and then others like an Arch, there might be a little bit more appetite for Sol or ETH, but you're still talking, maybe half a dozen max eligible assets. You can't borrow against meme coins. You can't borrow against long tail DeFi assets. So it's just across the board way more conservative.
So one kind of maybe taking a step back a little bit, perspective and question or subject that I was curious about with your perspective is, we had DeFi 1.0 and we had, 2021, 2022, the boom and the bust. Now we've got sort of like DeFi 2.0. And I don't know, maybe we're drafting off of that terminology too much, but and I think, like there's really smart, pundits and academics all over the world that say, like Carlota Perez talks about how you have a run up and a bubble and then a burst, and that's how technology, actually gets widely adopted. I'm just curious, like, what's your 10,000 foot perspective on what DeFi 2.0 means? We talked about and even, Vance and I talked about this with our LPs when we're talking about the funds. It's like, it's kind of back to the classics in a lot of ways. And there are some, Maples of the world who are going to survive through that transition. But then there's a lot of ideas that are coming back that, maybe should or should not be coming back. But one of the things we talked about at 1.0 was just all the innovation that was going to come on chain. Maybe some of the regulatory changes allow us to have the structural like clarity on how to operate with a foundation or a company, a development company. I'm just curious, like, how do you see the prognosis for 2.0? And is it fundamentally different from what we thought it would be with 1.0, or do you think that it's kind of like, hey, we still have a lot of work to do to accomplish the goals that we set out in 2019?
Yeah, it's a good question, and I used to read a lot of Carlota Perez as well, and so I tend to agree that that's kind of the stage we're at in the cycle, which is like we've been through the bust, and now the adoption is kind of there, but now the valuations kind of haven't caught back up again. So I think there's a lot of work still to be done on kind of refining and perfecting the ideas from DeFi 1.0. And you can see that the things that still have the most traction, it's like lending, stablecoins, basic forms of DEXs and derivatives products. I haven't seen anyone tackle options again.
But not for failure of trying.
Yeah, exactly. But yes, I think there were a lot of there was a lot of let's call like points of distraction from DeFi 1.0. Like as you mentioned, you had to go and set up these cumbersome foundation structures, significantly decentralize, and have a lot of like on-chain governance, time locks, that type of thing. And so there was a lot of fluff that went along with actually building working products that distracted you from going and finding customers and perfecting your products. And so I'm hopeful that DeFi 2.0 can actually go much faster in terms of hitting the types of milestones and growth that we had wanted to see in 2020 and 2021, because we're starting to get more of that clarity coming down from the from the regulator and the SEC, which allows you to you can run a more centralized DeFi business, provided you meet certain basic disclosures and protections to ensure that you're not doing anything fraudulent or nefarious. But it gives you the freedom to just focus on building a better product. And the fact that you don't have a regulatory crosshair on your back obviously makes it easier to attract customers, right? It was super hard to go and talk to the Millenniums or the Citadels or these other players when the space was being so harshly cracked down on in the past. And now that you kind of have that blessing, I think it's much easier to have those conversations.
Shout out to today's sponsor, Katana. Katana is a DeFi-first chain built for deep liquidity and high yield. No empty emissions, just real yield and sequencer fees routed back to DeFi users. Incubated by Polygon Labs and GSR, Katana is launching with notable ecosystem of primitives, assets, and partners like Morpho, Chainlink, and more. Katana's 1 billion KAT campaign is live. Bridge and deposit directly into Vault in one simple click and start earning immediately on your Ether, Bitcoin, USDC, and more. Follow the link in today's show notes to get started. EigenLayer is ushering in crypto's cloud era with the launch of EigenCloud. EigenCloud is a full developer platform that gives developers cloud-grade programmability with crypto-grade verifiability on any chain. EigenCloud's use cases don't stop at crypto. AI's rapid growth is reshaping how we live, work, and connect, which has simultaneously made it today's most important and least trustworthy technology. EigenCloud has arrived just in time to enable verifiable AI infrastructure with crypto economic guarantees, where incorrect behavior gets financially slashed. This isn't about picking winning apps or chains. With Eigen, stakers can own the fundamental building blocks of the verifiable cloud. Every application built on EigenCloud draws security from staked Eigen tokens. Every crypto economic guarantee is backstopped by slashable staked Eigen. To learn more about how the Eigen token is securing a new class of verifiable apps and how to get exposure to this growing class of crypto infrastructure, follow them on X at EigenLayer. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
One question I had just on the lending space is just the origination function of, like Athena originating the basis trade, you guys doing a lot of Bitcoin backed lending, people like Neutral, which are kind of trying to expand the Athena style basis trade to just like the middle tail of alts. But maybe if you could speak about how origination has changed over the years and where just a lot of the meat on the bone for origination is today. And just to tee it up, I know you talked about Bitcoin as being kind of the mortgage-backed securities of crypto. It has the most scale. It has the most reasonable APY. You can be doing it the safest. But maybe if you could just kind of start with that and then talk about the origination landscape across crypto today.
Yeah, for sure. I think In terms like we talked before about how the market size today is about 20 bill in terms of Bitcoin back to lending, and on a Bitcoin market cap of a little over 2 trillion, you're talking about a 1% penetration. So it's still relatively small. Like this is quite a tiny market, but if we think the reason I think Bitcoin is kind of like the mortgage backed securities of the millennials and the Zoomers is uh, you know I continue to think it's going to increase and appreciate in price. And so let's say Bitcoin doubles over the next 24 months and you're looking at 4 trillion. I think it's not a stretch to see that the lending or the loan origination market could expand from 1% today to maybe 5%. In equities, it's kind of in that mid single digit level. And then 5% on 4 trillion, you're talking about suddenly a $200 billion Bitcoin back to loan market. And I think the reason for this is that Bitcoin's going to make its way into everyone's portfolio over time. Because in the same way that real estate was really the wealth accumulation vehicle of boomers, you had this secular trend of declining interest rates and easier access to mortgage finance through things like securitization. And so most boomers had a lot of their wealth in their house. And I think the millennials and the Zoomer generation is kind of in a lot of ways priced out of real estate, but they can buy and start buying into Bitcoin. And so I think over time, the game for them is going to be accumulating more Bitcoin, and they'll be able to borrow against it in the same way that boomers borrow, home equity lines of credit against it. And so that's why I think it's going to over time be an extremely big institutional market. And the way that will occur is that institutions will start investing in, portfolios of Bitcoin backed loans. Pays a good yield. It's well secured. It's pretty short duration. And so that's where we see that industry kind of trending over time.
And the syndication side doesn't really happen today, right? Like
No,
it feels
not
like
at all.
that has not been recognized yet.
If you look today at the largest lender in the space is Tether. Tether provides loans collateralized by Bitcoin, but you got to post the Bitcoin to them in order to do that. And whereas in mortgage-backed securities markets, you have a basket of 10,000 mortgages, but the houses, the deeds to the houses are not all held by the investors. They're held in a vehicle, and the investors get secured bonds of various levels of protection against them. But that's what all of your pension funds, your insurance companies, and your major your major institutional investors put money into. And that's what the maturity of this market will look like in the end state. You'll have an insurance company who's got bonds which are backed by Bitcoin backed loans under the hood.
But fun fact on insurance companies, which I just learned this past week, is if you hold Bitcoin on your balance sheet, it's a 30% capital charge. If you hold IBIT on your balance sheet, it's 100% capitalized, which is kind of and none of the insurance companies actually own this yet, but the insurance regulations are still catching up. And talk about large pools of capital that are untapped. The second that you can have a full collateralization, which basically means that you treat it like a bearer asset and it's treated the same way as cash, an equity wrapper for a Bitcoin or a crypto asset has a better capital charge for an insurance company's balance sheet, which is just crazy.
Yeah, it's crazy. Talk about, as we were talking about before, like where the SEC kind of wants to remove this forced intermediation where it doesn't make sense and is kind of already handled by the technology. I think that's like a kind of prime example. But yeah, so I see that being institutionalized, and you can see on the basis trade, Athena is trying to do a similar thing, right? Like they have this concept where they want to take the basis trade, what they put on with USDE and SUSDE, and effectively put that in an institutional wrapper that could be a fund vehicle or some other, maybe a structured note that institutional investors can access. I think Saylor's kind of pioneered this. Like I'm not the world's foremost expert on strategy capital structure, unlike Jeff, but what I broadly observe is that he's shown that there is institutional appetite for structured Bitcoin products. And using financial engineering to kind of parse that out. And if you look, we can try and do that with Bitcoin-backed lending, and as can other people. And then Athena and these other models of the basis trade can do that with the basis trade as well. So effectively securitize it, tranche it out, and offer different structured products to institutional investors. And those are kind of three verticals you can see that in. You have the volatility of Bitcoin, you have the yield from Bitcoin-backed lending, and then you have the yield from the basis trade and the funding arb.
Is there, I mean, what other kind of lending? I mean, it feels like the other stuff that's changed since 2021 are these kind of like the move from Aave V3 style markets to kind of more like risk curated markets like Morpho has. You have Wildcat, which is pioneering the under or partially collateralized lending space. Are there any other veins of real lending activity in crypto, outside of kind of the OTC desk and then the fund lending? Like is Bitcoin mining still a big source of lending flow, or where else are you guys like looking at and are interested in?
I think the short answer to that is some of these treasury companies, but the the answer to one of those earlier questions is, yeah, miners are still present, but what's happened there is that market is starting to consolidate. So now it's like there's a couple of larger miners who are taking out monster debt facilities, and have a lot more leverage at the table in negotiating, like a Marathon, for example. They put out an announcement the other day, but so that space is consolidated. The market makers don't do a ton of borrowing at the moment. They're relatively constrained because they won't post collateral, because for them, posting collateral is always less efficient than just turning the collateral from the asset they have into the asset they want. And so they go to the unsecured markets. And so you can see Wildcat. But I think the issue there has been the buy side appetite. Let's say the people who have capital who are like, I'm happy to get a 13% yield unsecured. And I think the issue with those markets is they're relatively uncurated. So it's like a player can go and request a loan, but there's not a lot of, there's not somebody kind of vetting that on the other side, unless, except for the investor themselves or the lender themselves. And then you have in between, you have the morpho markets. You have these curators, and I see that expanding a lot because I think there is a really specialized skill set in curating which assets and doing the credit work. So you've got Gauntlet, MEV Capital, the Steakhouse guys, um, um, RE7. So you've got half a dozen of these players, and you've got more entering that. And you have Morpho, Euler, they kind of operate similarly, and they have a lot of the same kind of curators coming across. But I do see that curator role as being one of the kind of the biggest, fastest growing segments that we see across the DeFi space. Yeah, and then you've got the more conventional altcoin lending.
The other one I was going to touch on was just like people like Apollo both being an issuer and being an underwriter for some of these markets. Yeah. Like Steakhouse, I think, has a Apollo private credit looped credit sleeve. Does that meaningfully expand the universe of capital inflows, or is that just kind of Apollo trying to leverage cheap capital in crypto and take it elsewhere? Just like, how do you see that?
Yeah, these are the two different strategies you can run on the whole tokenization of assets. So on the one hand, you have large traditional funds, and in this bucket, there's not just Apollo. There's Apollo, BlackRock, Wisdom Tree, Franklin Templeton, and these players. The thesis is we have an asset management product. What we're going to do is we're going to seek a new market to distribute this to, and that market is on-chain investors. And they can do it directly, or they can do it through these kind of yield enhancement strategies, like Apollo has with the Gauntlet Vault and the Morpho integration. So you loop it; it pays you 12. You loop it a few times; it pays you a high teens rate. But broadly, the strategy there is they already have an existing business. How do they find a new market to distribute it into? And then you've got the opposite side, which is kind of the punt that we are taking, or the bet that we are taking, and the bet I would say Athena is taking as well, which is you have a crypto native product where the yield and the source of returns is on chain. So in our case, it's Bitcoin backed loans. In Athena's case, it's basis. That product you can't go and buy from Morgan Stanley. Morgan Stanley doesn't have a tokenized basis trade or a fund that does the basis trade, and they don't have a fund that does Bitcoin-backed lending. So can you take the crypto native product that's unique and differentiated, and can you package that and sell that to TradFi investors? I'm more confident in that because I think it's a product they can't get elsewhere. So you're effectively in a market of one or two. It's you and maybe some other, one other player that can do it. Whereas when you take a fund asset and bring it on chain, you're competing with every possible source of yield or return on chain. Apollo's competing with everything else that is yielding 12%. And it turns out that on chain investors have a different time preference and they have a different return hurdle to what your average pension fund or family office has.
Well, one question on that is like, like let's say you went the other way and you said, let's put Syrup USDC in a bond ETF format and let's offer it, next to Apollo Private Credit in a prime brokerage, by Morgan Stanley. I assume there would be all sorts of hurdles from Morgan Stanley compliance. Like we can't even trade IBIT, through Morgan Stanley. So maybe in a bond format ETF, this would be more approachable. Maybe they'd still have some concerns, but is that other way strategy something that you guys think about? Like how hard is that to actually pull off? Can you get in this walled garden and really make hay, or is it just there's so many hurdles that it would just be difficult?
There's definitely a lot of hurdles. I think it's kind of, let's say that's probably phase two of the treasury company trend that we're seeing at the moment. Like I saw, you've obviously, we began with strategy and then the BTC treasury codes, then we went to alt assets. Last week you saw, Athena had stablecoin X, right? Which is a little bit of a hybrid, predominantly focused on the governance token. But I was thinking today, could we take Syrup USD and put it in a BDC, let's say? A BDC is a business development company for those
SPAC.
who similar. Yeah, very similar. It's effectively a vehicle that invests in debt and private credit, and you can either have debt or equity in it. But Blackstone does a lot of them. BlackRock does a lot of them, and but it's the net. This would be the next stage where you are investing in a vehicle that does yield plays. And there's no reason that you couldn't have a BDC that does like the basis trade, but it's a tradable vehicle that does yield and credit type plays. And I think that would be the next evolution of what we're seeing with the very basic treasury companies today. But you're totally correct, Vance. Like putting that, you're not going to end up with that on the Nasdaq or one of the major exchanges day one. So it's going to begin as OTC, and then and direct sales, and then over time you're going to be able to get it onto different venues, I think.
So this is going to be my question, which is, it seems like both strategies you just described, like Franklin Templeton are looking for new customer base with on-chain clients. And I think Syrup USD, USDE, the Athena product, and I think those are 1 and 2 in terms of, what let's call yield coins versus stable coins. You're also looking for new distribution channels, which is you've got the on-chain and the capital is, in a certain sense constrained as to whatever's on chain right now. But as we start to see more of the stable coins, actual stable coins look to have that yield element, especially as we should talk about the Genius Act and how that will apply here. You can't have yield pass back, but you can have USDC flow into something like a Syrup USD, which is probably where the majority of the growth is coming from. Maybe my question is like, as you think about stable coins and yield coins as like two kind of related and potentially combinatorial assets, how do you think about the growth vectors? Is it the BDC route where you're going to try and equitize this, like reverse tokenize the distribution channels, or
then later you tokenize the BDC,
right?
and
Exactly.
Put it on Robinhood.
Loop and fees all along the way.
No, I think of it. It's a good question. I think of that as an interim solution. So what you're trying to do is like, it's this whole, we're talking about Carlota Perez before, but you also have the Stephen Kuhn idea, right? Which is that, you don't convince, like in a scientific revolution, you don't convince people. It's just the older people die. And so you have the portfolio managers of today can buy a BDC over the next couple of years that has USDE or has Syrup USD in it. And so you're providing a distribution channel that meets them where they are today, not where you want them to be. And then the millennial and the Zoomer PMs who are coming through, they will eventually just be subscribing for things in stablecoins. I think with the passing of the Genius Act, it's kind of like the arrow of time is going in one direction, right? And so the direction of capital markets is it's going to be settling more and more in stablecoins. It's almost inconceivable that it's going to hit some level and stop where people continue to decide to use fiat. And so the way I think about it is the two are linked. So you have if you legalize stablecoins with the Genius Act, but you can't do passback of yield. But it's inconceivable that you would do that and then not contemplate that there are going to be savings products built on the stablecoins, and that's where I think SUSDE, Syrup USD come in, as they're products built on top of stablecoins that, we're not the same issuer, but we allow people to earn a yield on their stablecoins, and that's where I think the puck heads over the 10-year horizon, let's say.
Right. We just don't want to have to wait for an inordinate number of funerals to be able to have progress.
Yeah. Exactly.
It is I've heard this take that we don't need more stablecoins being issued by people, but I think Syrup USDC, from starting relatively humble beginnings, has grown into a real juggernaut, and it does feel like this Syrup USDC concept. It's not quite a stable coin. It's not quite kind of a yield bearing pure like bond instrument. It's somewhere in the middle where you're able to create a lot of value matching assets and liabilities, as well as making not just debt, but like liquid debt. And I think that is what Syrup USDC does so well in terms of making it something that is exchangeable instantly for US dollars. And I guess there is some cool down period, but do you see this trend of, maybe like Wildcat has its own stablecoin, you guys have your own stablecoin? Like, is this going to be an era where there are hundreds of different stablecoins? And I guess what are the second order effects of something like that?
It's I think it gets really complicated if you start accepting the yield bearing, let's call them yield bearing stablecoins, or the liquid dollar, because we call Syrup USD a liquid dollar product. But if you start accepting these as money and using them for payments, I think it becomes really hard, because then let's say I have Syrup USD and Michael has Wildcat USD, and we're trying to work out, should these be at parity, or is there a different risk level? And I think that's where, if you just have the basic stablecoin themselves, whether it's USDC, USDT, USDE, that's being used as kind of the medium of exchange that doesn't have yield and credit risk involved in it, it keeps things simpler for people. If you look back in the era of every bank issuing their own private money and IOUs, it became really difficult and costly to kind of decide the discount factors that should be applied between them. If you're a trader in Texas and somebody hands you private money issued by a bank up in the Northeast, well, that's non-trivial to go and redeem that. So I think the dollar products continue to get built, and there'll be many different kinds of dollar products, because wrapping it in a token is a very easy way to package it for distribution, whether it be a Syrup dollar, a Wildcat one, or an Athena one. But I don't think any of us intend for it to be used as kind of spent in the same way that currency is.
I'm not using T-bills to pay for coffee.
No. But like, one example is, CoreWeave, which is this large data center kind of neo cloud, has done these big bond issuances, and the bond issuances don't really trade on exchanges. Like, you can check the price every once in a while, and there's like a trade every once in a while, but it really is this hand-to-hand, market that doesn't really exist, and it gives no transparency or price discovery to the underlying. If they just had like CoreWeave USDC or CoreWeave USD, they could back those issuances under that and have this thing that's more liquid and can reflect the underlying value. And I do think there is this case where there should be more stablecoins in terms of different issuers of these things, just because they do provide fundamental business value to both the business and the underlying instruments that you're trying to monetize.
No, I think that is a really good point. Having a savings product or a yield product that trades at par, like as Syrup does and SUSD and these others do, where the yield varies, but effectively it's always kind of liquid and trading at par. I think that is really important. What we found was one of the big unlocks with the Syrup USD growth was when we introduced secondary liquidity for it. So when we had a strong, deep, um, uh, deep pair for it on Uniswap and other dexes. So folks didn't have to wait to get redeemed out. They could redeem out, effectively trade out of it straight away with very little slippage, and you can kind of see that in you can see that there's some appetite for this in traditional markets, because if you look at like the latest MicroStrategy instrument, it's a thing that trades around par where the yield varies in the same way that our yield, Syrup USDC yield varies, and SUSD yield varies. And so there's some appetite for that in TradFi.
Sid, do you see eventually? It kind of seems like the construction in between something like Maple and Athena is like relatively similar. You're kind of just going after different strategies or different pockets of yield, and then there are other like attempts at this like that are maybe a little bit different construction, like Cap or something like that, where there's incentivizing different operators to go out and earn yield in whatever they want that accrues to stablecoin yield bearing like instrument, maybe not exactly stablecoin. But it seems like eventually, right after theoretically, like, you max out your market on, Bitcoin backed loans, or Athena does on, the basis trade, right? You would go after similar markets, right? Do you see eventually convergence here and competition in between, like the Maples and the Athenas of the world, or when was that?
It's an interesting question, and I know Guy pretty well and the team there. So I would say, at certain times, like when Bitcoin runs up, basis basis picks up, and the yield from their strategies pick up, and so there's like a natural competitive tension where their yield probably climbs a bit faster than ours, and people might swap or reallocate between us. So but that's kind of like a very narrow sense of competition, and that we're competing to offer people a yield, and because the market's so small, people kind of just focus on the top line number of yield. But I think as the market expands, which I think we both, both us and them think it will, you're going to naturally end up with specialization. Like if you look at an asset manager, both Citadel and Apollo are asset managers, but Apollo is specialized in credit and Citadel is specialized in trading. And the headline number that you get is, well, this was the return that the asset manager delivered over a period of time. But under the hood, there are very different things happening. And if you're an investor, you may not want to allocate entirely to one of them because you want to diversify, you want to have multiple strategies, you don't want to be, all in trading or all in credit and fixed income. And so I think the market will grow enough that each of us is able to find our own specialization, and we'll just focus on disrupting the TradFi players and eating their lunch instead of each other's.
And is it zero sum between the asset managers of the world within crypto and the stablecoin providers, or is it positive sum? Like we've seen Sky give you guys a lot of capital, and that's grown the pie, and Athena's grown the pie because Sky is their largest depositor. It does feel positive sum, but I think it can be framed in the zero sum lens. So it'd be good to get your take on that.
Yeah, I think. My short answer is I think it's positive sum, because if you look at when I was in banking, we covered a lot of lending companies, and I always wondered when I was a junior associate there, why don't we just do the lending and then cut these guys out? But the answer was, there was enough of an ecosystem where the bank I was at didn't necessarily want to do loans to self-employed people or smaller car loans. They had a certain type of market they wanted to go after, and they were happy to just partner with the lending companies and participate there, but in a way that reduced their risk. And so I view the partnership or the combination between us and and the Maker Sky ecosystem as they are looking to be the central bank, and there's certainly a principal agent problem that having partners like us and several partners, whether it be us and Athena and others who specialize in that, we kind of keep each other honest and we address the principal agent problem in some way. So ensuring that we provide quality underwriting and Athena provides access to the basis trade in a safe way. And by having this two-step process where they are the central bank and we are kind of, in a sense, a commercial bank, or another way of looking at it is they are a fund of funds and we are one of the fund managers they choose, keeps it enables them to get more leverage on their time and not have to staff out a ton of people themselves, and also to ensure they have the best product in each category, because if we don't deliver, then we can always be swapped out for somebody else, and same for Athena. So I think it's actually symbiotic.
Yeah, I think it's kind of the equivalent of venture capitalists saying, we should also be starting these companies.
Yeah.
And every once in a while that does happen, and usually that's a sign that the entire concept is undifferentiated and it's likely to be abstracted by somebody else. But I think what's happening with so many of these stable coins, syrup USDC included, and like these central bank concepts, it's just like the world is splitting. It's getting bigger, but it's kind of going into these centers of excellence that is good for the entire space. And yeah, it'll be interesting to see how it plays out. But I certainly don't think it's negative sum for anybody as long as you're playing these long term games. And there's $270 billion of stablecoins on chain. So even making a 10 or 20% dent in that is a huge deal going forward.
And I think that's going to continue to grow a lot. If you look, like when the Genius Act got passed, apparently some of the positive feedback came in from like KFC franchisees who liked the fact they wouldn't have to pay, interchange fees and to the card processors, so Visa and Mastercard. And I think on that trend, you know, you look at some of these exchanges who are talking about doing 24/7 trading. Well, what if they could have 24/7 funding? Like, surely those exchanges want people to be able to fund their accounts more often during the day. And if you're doing that through the banking system, you can only do it, 9 to 5, 5 days a week. Whereas if you accept stablecoin deposits as, one of these trading venues, then people can deposit in 24/7.
Yeah, I feel like it took a little bit. This is a great example of it takes longer than you think it's going to take. But these were all things that we were talking about, in 2017 and 2018 about why we thought Wall Street might be excited about this stuff. And it turns out they are, but they just needed, regulation and less risk and all of that stuff. And it just took a little longer than we thought. But I want to return to, I know we don't have too much more time, and I want to return to this idea of kind of where credit or leverage is building up in the system and the difference in market structure this time around. And, one of the, I don't know, benefits, but maybe, one of the, something about the way that it was all set up last time is that you had fewer lending shops. And so it was kind of easier. You could kind of look at Genesis's loan book. They did these quarterly reports and be like, wow, $50 billion loan book. I guess people are borrowing to punt long, right? And people weren't as in tune yet, right? But a lot of the funds that were going into GBTC were also kind of this indicator of leverage buildup. It seems more dispersed today. In some ways, it's much more visible because it's on chain. But also there are many different shops and there's less, it seems like, kind of centralized lending activity. And I'm just curious, like, if you're looking at kind of markers or like buildup or as an indicator of, how frothy things might be getting, like, how would you, if you're just kind of an average retail person listening to this, like, what would you be looking at?
It's a good question. If I were average retail person today and I was trying to assess the level of leverage in the system, Galaxy does a pretty good. So you used to look at the Genesis report, which I think was was some of the best research.
Those were so good when those used to come out.
Yeah. No, they had a great team putting those together. Like, I always read those, and I think nowadays Galaxy has a really good report on lending. They did one maybe a quarter back, but it had effectively a leaderboard of like the top lenders within the space, and that's where I pull that number from 20 to 25 billion from. So in the lending space today, you have Tether somewhere in the low teens billions in terms of loans outstanding. They're the largest, and then it's daylight between them and the next largest. The next largest, according to the previous report, was Coinbase and Galaxy, and they were both sub a billion. And you had Two Prime and Ledden also in the kind of the top six, and us. I would say now, our loan book's about $1 billion, and so we're probably somewhere around that, maybe like top three mark. But if you wait for the next one of those, I think they're produced on like a quarterly basis, but that is one of the best resources on the size of centralized lending today. And I would pay attention to that. So at 20 to 25 billion, as I said, we're still like only 50% of what we were last cycle, which was about 55 billion at the height. So still relatively unleveraged. I think, and the other thing you can look at is if you want another more real-time barometer, I would go on look at Wildcat, which has the uncollateralized lending, because that's going to be in the higher risk category. So if you one day see that spike to 400 mil from where it is today, like that would be an indicator of frothiness picking up in the space. And then you can of course look at us and Aave, but I think typically, and you can view the metrics through DeFi Llama, but if you look at the level of leverage on the DeFi protocols, where it be us or Aave or Morpho or Euler, that will also be a proxy for how much leverage there is in the space.
Do you think it gets back to that 50, 60, 70 billion? And if so, over what period of time?
I think it goes beyond that. I think it can get back to the 50 to 60 billion within the next 12 months. I mentioned the number of, can Bitcoin backed lending get to 200 billion in the next 24 to 36 months? And I think a lot of it is going to be enabled by stablecoins, because ultimately they kind of set the boundary condition of how much can be lent. We're all lending stablecoins, so the capacity to lend derives from the capacity of stablecoins. But I could see us easily getting past the 50 to 60 billion over the next 12 months, and then really accelerating from there. Because you look at the source we didn't talk about much was these treasury companies. Now we look at them as an interesting potential customer to lend to over time, because they already tap capital markets through convertible bonds and pref equity. But over time, they might want to add a form of secured facility to like buy the dips. Let's say Bitcoin dips back to 90K. I would want to have a facility I can draw at a day's notice and go and buy Bitcoin at 90 if I was one of those companies. How are they going to outperform each other competitively? They're going to have to be better at tactically buying Bitcoin or have cheaper cost of capital. Now, when you issue pipes and things, those investors want to hit a 20% plus IRR, right? Whereas when you borrow against Bitcoin, it's an 8% cost of capital.
And it's not like you can spin up a pipe in 24 hours.
No, exactly.
And so like a Maple, I mean, there's two versions of lending to these companies, right? One is doing the converts directly, and the other is like this asset-backed, kind of off-balance sheet style lending where you actually have the crypto collateral. Are both of those interesting to Maple?
Yeah, more so the second one, because there's the converts, but the converts are longer duration. And then, there's a kind of implicit understanding that you're probably going to convert into the equity. Like that's where the return really comes from on those things. So our interest is more in the secured facility. And I think where we partner with them is we can offer them something that's cheaper, faster to draw down, and more flexible. You can draw it down and repay it in a week if you wanted. So you can use it as bridge finance that complements your converts and your pref equity and the other stuff you're doing. But it brings your overall blended cost of capital down. So when maybe you didn't have to do it when you were one of 3 Bitcoin treasury companies, but when you're the 25th one, it's a much more competitive space, I think.
Just as context, as a venture firm, it's pretty typical, and we utilize this as well, to have what's called a capital call line of credit, where if you need to make an investment in, let's say it's a hot deal and you have a week, but your capital call timing is, you send it out to your investors and say, hey, we're calling 10% to make this investment. That takes 2 weeks. We have leveraged, a capital call line of credit, which you use temporarily, and then you pay down once the capital call comes in.
Yeah. It's like a revolver, but it allows you to, to not miss out on those deals. And that's kind of similarly what I imagine for these treasury companies. And we've had conversations with a few of them. So I think, I think that's going to be a big market that will accelerate some of the Bitcoin-backed lending and getting us close to that 50 to 60 billion number.
One question I had for you just on basis, I know we're at an hour, but one thing I've noticed with basis is that it doesn't spike as high and it doesn't persist for as long. And a lot of that is just how much capital and how much open interest has come into crypto. And so that kind of isn't as reliable of an indicator as it used to be. But how do you think about basis going forward in terms of increasing TradFi usage of that as a yield opportunity, but also just like how do you think about the barometer of, oh shit, there's too much leverage in crypto, or there's not enough, or just like a market health check?
So I think when you see basis spike really rapidly, and as you said, as you noted, Vance, it doesn't rise as acutely as it used to, and so I think it's a general barometer of kind of frothiness in the market. Like if you see sustained basis, it's kind of more bullish conditions, and we use basis to re-rate our book. So if we see basis spike, we will go out to our lenders where we have recallable loans, and we'll often reprice them up. Maybe it's 50 or 100 basis points, because it's like when basis spikes, it's like the Fed lifting rates in crypto lending. It suggests that there's a new it's the proxy for the risk-free rate, and it suggests that if it's rising, you should be charging more for interest. And we also see more demand from the borrowers, so borrowers don't really push back as much. They're willing to pay more because they recognize the risk-free rate has increased. Over time, as the space institutionalizes, I see that coming down. Because you just look at the TradFi instruments and you don't get paid nearly as much for, effectively like a funding rate arbitrage. But at the same time as well, like crypto-backed lending, as it matures, will also come down in spreads. As more, because I think it's kind of mispriced at the moment, where the TradFi market assumes it's riskier than it is today. You're significantly over collateralized by Bitcoin, which you can go and liquidate billions of on a Sunday. There's not too many assets that you can do that with, and so I think it's probably priced too high relative to where it would be if everybody fully recognized the true, or appropriately priced the true risk.
So, I mean, maybe just to follow up on that is, let's say the Fed starts cutting rates, and rates are so much higher than they were, in 2021, and it feels like the long end is probably not going to respond, to a short end cut. But there could be this thing where you start cutting rates, things get frothier, credit spreads kind of blow out even harder.
The two diverge,
right?
Like
that'd be the counter to that, right? But it would just be good to get your take on, like, in a world of decreasing interest rates, and I think that's coming. What does the lending landscape change look like?
Yeah, it's interesting. I think you've got the first and second order effects, but I think typically what we would see over the short term is that if you cut rates, risk assets typically trade higher because of a lower discount, and so Bitcoin and crypto sees appreciation. What that does is that then pushes up basis. So you see almost the TradFi and crypto economies start to bifurcate and diverge from each other. So as the Fed cuts rates at the short end, risk assets will trade up, basis will trade up. We'll see more borrowing demand, and we'll start charging more for interest rates. And so our lenders, the folks who give us capital, will start getting paid more, which you kind of need to, because you have to keep them sticking around, because otherwise they will say to themselves, well, why don't I just go out and buy market beta? Like, why am I collecting yield? You need to pay me more to keep me in this product. Otherwise, I'm just going to go and buy BTC or Sol or ETH, or just get the market beta return.
Yeah, it's you either sell them more duration, which is tough, or you sell them different credit mix.
Yeah.
And that credit mix on the short end, there's not probably a ton of options other than something like what crypto has to offer, or other. I mean, maybe shorter term financing things like exist in a prime, but I generally think of like DeFi lending as being very long credit spreads. And
Yes.
the world of lower interest rates on a nominal short end basis probably get better credit spreads on just about everything else.
Yeah. What's worth noting, just while we trip down memory lane, 2021, 2022, when you're doing Bitcoin-backed lending, often those are getting double-digit returns, and the over-collateralized stuff initially could fetch 12, 13, 14% when you're posting excess Bitcoin to borrow. But keep in mind, that was when the Fed funds rate was like zero. That was when SOFR was zero, and investment grade stuff was SOFR plus 2, so 2%. So you were getting effectively a 10% spread to investment grade stuff and a 12-13% spread to T-bills. It was like exactly to your point about credit spreads in crypto.
Maybe a good time to do the BDC if that
Yeah, if that ever comes back.
All right, guys. Well, Sid, you've already been super generous with your time, man. And just a hearty congratulations again. I feel like Maple was really one of those names that, was kind of you really, put the work in over the course of the last 18 or 24 months. And it doesn't happen overnight, but I think people are waking up and realizing. And I think 3.2 billion in TVL, it speaks for itself. So congrats on all the hard work and success.
No, thanks for having me on. It's just a love of chewing glass.
Love
All right, well, thank you, brother.
Love it.
All right, sweet.
All right,
Sid, appreciate
thanks,
you.
guys.
Cheers, man.
Later.
Appreciate
Bye.
it. See ya.